Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, May 20th, 2021. In this video, I will begin with a very brief update of the broad markets since I already covered that earlier, just kind of update since the last video earlier today, and then roll into updates on gold, the euro, US dollar, Bitcoin, and Ethereum, Ethereum, and so the cryptos. At least those two big ones that I've been tracking. And I'll do an update on Treasury bonds as per request of one of the subscribers of the site, and then a quick update on commodities. We're not going to go into each commodity, just want to update that DJP that I've been watching or using as a proxy for the commodities arena, all commodities. It's a diversified ETF. So I'll get to that at the end. So I'll go through in roughly that order. Let's start out here with the markets. Not much to update since the last video I did earlier today. Here's that downtrend line on ES, the S&P 500 futures. We did close back below there. We were up there. I'm using a bar chart here. You can flip over to candles by doing this, and you can see that 60-minute candle we were working on. Remember, right here, if you look closely, that skinny part at the top, that's called a shadow. That means we were trading above it during the video, and sure enough, we closed back down on the trend line, the body, and that's the most important thing on a 60-minute chart. So that is a reaction right there. That helps to validate this trend line. Next body, the top of that body was there. The third one, the top of the shadow was there, and now this other candle. So we're consolidating right here, and you can look at it this way. What I just drew is a possible bullish pennant. This is resistance. Again, you guys know my thoughts. I'm not going to spend a lot of time on the market, even if this bullish pennant breaks out. If you're a bull, the measured target is the flagpole. Added to the bottom of the pennant, lowest point, or the point just before it breaks out. So that would take you all the way up there. And that's certainly a possibility. A breakout's going to take you above the trend line. But remember, you still have pretty big resistance here at about 41.80 on ES, the S&P 500 futures, to contend with. So you got to be on alert if you are bullish and looking to play a breakout of that potential pennant consolidation pattern of what could prove to be a whipsaw signal, breakout that then gets sold into. So again, you have resistance just ahead. And of course, my preferred scenario is a failure here at the trend line and then another leg down. Like I said, if we get much more below the recent lows, we may see some of those breakdowns that I'm looking for in the financials and industrials. So that's the brief update. And again, I've shifted more of my focus, or putting a bigger weighting on the S&P 500 now, mainly because that's what I need to see break. We've already had tech correct quite a bit, and now I need to see the S&P 500 break, or otherwise, if it doesn't break, we can continue on up and make another marginal new high and continue the pattern we've been in for months now. Something I meant to bring up in yesterday's video, and again today, and I haven't, but this definitely warrants talking about, and I'll probably talk about it a little bit more when I get into the Treasury bonds here, is just recently, last month or two, I started to make a prediction. A lot of times I'll throw out, hey, this could happen, this is one thing to look for, but one thing I've been adamant on, a couple things, is the inflation trade for a while, commodities, just the value of nothing else. Even if we didn't see inflation, I've been saying for last year or so, commodities were beat down, and they don't go to zero. They don't file for bankruptcy protection. They were very, very cheap relative to where they've been in recent years, and et cetera, et cetera, et cetera, bullish charts. The other thing, just a month or two ago, I started saying is, mark my words, you're going to start to see the Fed backpedal. And with the way it's going to happen, and this is finally started to materialize, they're not going to come out and pull a 180. I know this Fed. This Fed is the last thing you could put a gun to Powell's head, and he would not come out and shock the market and do a surprise rate hike, or a surprise bond taper. So the way it's going to happen, you're going to see them start to tap the brakes gradually at first, but then it'll begin to accelerate. And that's what they did yesterday. The Fed, Fed minutes that came out. The Fed is now did go on to say that they're basically they shift to a more hawkish outlook. They said they will need to be more flexible. They expressed concerns about inflation and everything, before they were being completely dismissive of it. And what they're talking about now is they're very open to now reducing. They're going to start out most likely by cutting back on their bond purchases. You know, there's two ways they're gunning the markets and supporting the economy lately, and that's zero interest rate policy, keeping rates down at the floor, near zero short-term rates, and then also the bond purchase programs. They're doing massive amounts of bond purchases. So that they've come out and said, and that is a backpedaling. They're starting to, you know, acknowledge, hey, things are getting a little hot here. And again, it's a little bit at first, and that's what put the pressure on the markets recently. One of the headlines that put pressure on the markets. And again, it goes, you know, it flies in the face of what they were saying just, you know, a few months back. The Fed had actually come out and, you know, and this is again where I thought they were just crazy to do so. You know, Powell, you know, had stated they pretty much pledged to keep interest rates near zero through at least, by the way, his words, at least through 2023. That's a long time. Now, right, again, they're not talking about raising rates right now. They're going to, and that's the drip. That's what I was talking about. It's going to come on subtle, little, you know, flexibility now and starting to cut back on the bond purchases. And then mark my words, if and when that doesn't, and I don't think it will, you know, temporarily could cause a correction in commodities, but I don't think it's going to completely put the brakes on this rally. Again, I'm longer term bullish on those. Intermediate term bearish, as I've talked about recently. Near term for reasons I'll get into here again in the end of the video. But that's it. Let's just leave it here. There's the update on the S&P 500. Now let's roll into the other things I was talking about, starting with gold. I'll kind of jump over time frames here. This is a 60-minute chart of gold futures GC. One key level to watch is this uptrend line that's forming. We have enough reactions right here. We had pretty much a double bottom there. And that was our, you know, re-entry for long-term investments, long-term trend trade. And it's a trend line that will probably get visited sooner than later. And one thing that may cause a pullback in gold soon. It's been a nice run lately, and it's shrugged off some divergences, but we still have divergences building. In fact, from the last time I highlighted them, they were right here, and now they've gotten even bigger. They've gotten a little bit steeper. So there's a minor uptrend line. So at this point in time, there's a decent chance that we may get a pullback in gold. Pullback to the trend line should provide an objective long entry with a stop somewhat below. But again, define your trading style and time frame. If that trend line's taken out, there's plenty of support below it. So I don't think gold's going to go on and make a, you know, another multi-month low. I think it's just a matter of if that trend line's taken out. There's big support here about 1798. We'll call it 1800. But we may not even get there. I mean, that's been the MO lately. The gold pulls back and the buyers have come in aggressively. This isn't an uptrend. And there's just pointing out, if we do pull back, if you've kind of, you know, wanted to get on board and didn't think there was enough, a strong enough case to buy gold, and now you want to get on board, I'm just pointing out a level that would be an objective add-on or entry into gold. And again, if you're an active trader and you want to, you know, tighten up stops right now below some of these recent lows to kind of sidestep a pullback, maybe recycle back in, there's your level. And if that goes, then about 1800 or so would be your next level. That's the 60-minute chart of gold futures. Looking at gold on the daily time frame, it still looks good. I know I have a lot of lines here. Most important would be the bottom of this buy zone that was hit, as I just showed you. These were those two lows on the 60-minute chart. No divergence, not even anything close to divergence on the PPO or the RSI. They're pointing higher. Gold is overbought. Now you have to, you know, say again, this is kind of what I'm saying right now is, you know, if you didn't own gold already, is this the time to jump in and take a full position? No, it's overbought. Look what happened last time we were overbought. Did you want to be the buyer right there? So you were the bag holder, because that happened. The time before that we were overbought was here. What happened? It was a strong run, and we stayed overbought for a while. But again, the risk reward starts to diminish when you become overbought on a security like this, even in a bull trend. Yeah, of course, in bull markets, overbought can become overbought quite a bit more. And if I said oversold, sometimes I kind of flip-flop those words. Overbought when you're above this red line on the 70 level. Overbought can certainly become more overbought. So you don't go shorting in a bull market just because you're overbought. But again, it is kind of a heads up. Hey, your excellent opportunities in a bull market are when you're oversold. That's when you want to go long, and I pointed it out here at the bottom of my buy zone. It's a great op, and then there again, and look at that, both times, as I said at the time, we were oversold, just like we were here when we hit the top of my buy zone the first time on the way down, and that was a big bounce from there up to that point. So bull market, look for those oversold readings, and you want to get long. Usually they're one and done too. You don't say oversold very long in a bull market. That's the signature of it. In a bear market, oversold becomes more oversold quite often, or stays oversold for a while. It's the opposite in a bull market. Overbought can become more overbought. Sometimes you get a one and done, but sometimes you can stay up there. So enough on that. I think you get kind of my idea of where I think we are right now in that cycle. I see more upside in the coming weeks to months. It's just near term. Get a little frothy, you may get a little pullback here. And then of course I like to confirm or refute my analysis on on gold with what the dollar and the euro are looking like. And so what I'm looking at here, I'm starting on a daily time frame. I see some negative divergence here on the euro US dollar pair. This is a proxy for the dollar. It's the euro and the dollar is the pair together. Euro is the biggest component in the dollar index. So when this chart is going up, it means the euro is rallying against the dollar is falling. And a falling dollar is typically bullish for gold, as it has been recently. So a rising euro. This chart is positively correlated with gold, meaning when this is going up, typically gold is, and vice versa. All right. So, and again, that was, the case for correction was laid back, here, euro, and of course gold was correcting then, and there was a case to go long gold, and gold's been going up, et cetera, et cetera, et cetera. But now we have that divergence, potential divergence. It could get burned through, but again, kind of a heads up. And the euro's at resistance as well. The euro US dollar pair, that's a big level right here to me. 121. 852 right there. Lots of reactions on that level, and we're still pretty close to it. That's what it looks like on the daily chart. On the 60-minute chart, you can watch this trend line right here. You have an uptrend line that comes off the late April lows right here. Enough reactions to make it valid. And again, this is kind of more intermediate term stuff. If you're micromanaging a position in gold, last time you had a divergent high was right here. There was your uptrend line, there was your sell signal that put us in a correction. That ended with a nice bullish falling wedge pattern. It said, okay, time to get back in. Back long the euro, short the dollar. Bullish falling wedge with positive divergences, broke out, rallied, boom, another hit of the trend line. So we have a lot of hits of this trend line, 1, 2, 3, 4, 5, and it's a logical pullback target. So if that happens, that means euro down, dollar up. That could again put pressure on gold. And you also have the divergent high here on the 60-minute chart, which says there's a good chance you're going to get that. So that's the near to intermediate term outlook. And then longer term is this weekly chart. And big picture has a long-term downtrend line. Gold recently broke out of that downtrend line there. That's bullish, broke out, back tested, and we're at resistance here. There's 122, 141 on the weekly, and that's a level that's acted as resistance. So again, there it is. Gold's at the euro US dollar pair is at resistance, but longer term, I'm still bullish on the euro, bearish on the dollar. This is a long-term trend indicator, which is bullish. And when the white line here, the PPO signal line, is above the zero line there, that's a bullish trend, just as it was here during that part in time, back here. And when it's below, it's bearish. So again, maybe a little correction in the near term, but if and when, and I expect it to happen sometime soon, the euro puts that previous reaction high in the rearview mirror. We're heading up to my next target there, about 126. All right, enough on gold. Quick update on silver. If you're trading silver futures, 60-minute chart, you have a nice uptrend line right there as well, which we could pull back to. And you also have negative divergence. So again, at that recent high. So maybe a little near-term pressure on the metals, and it may depend on what the market does as well. Let's move on to the next one. Our next one I said would be Bitcoin. Wow, just a beautiful rejection yesterday after Bitcoin hit my second target on GBTC that I've had for months, almost a 50% drop from where I gave a sell signal back in February. Hit it to the button, reversed. Big reversal in Bitcoin futures here. That's BRR. And mentioned two levels. I said we had resistance here, which we had just hit and come off of about 47.71. And then I said, I believe I used the words not big resistance, but big resistance here. And that means golden shorting up, and that's what you got. So if you're a Bitcoin futures trader, we hit that today. And so far you're good. Big resistance means you're almost certainly going to have a reaction when you hit it, if you hit it, and that may be the end of the rally. Let me try to measure that drop for you right there. If I go from where we hit it down to low, that's a 10% pullback in Bitcoin. Is that 10? Let me see here. Yeah, about 10% in Bitcoin futures. Quick single day trade. And where we go from here, I think that's it. There's a good chance that could be the end of the rally. And yesterday I laid out an additional target in Bitcoin GBTC. For those of you that don't trade the futures, trade the ETF type instruments. Again, this is not an ETF. I believe it's categorized as a closed-end fund. It's very similar. But not exactly the same. T2 again hit to the button yesterday and bounced, and on this chart, the only resistance I see, again, that's why I use the futures. I don't do this to make long videos by covering futures and ETFs. You got to watch both. Remember, the futures is a whole nother world. You're seeing things you just don't see on ETFs and individual stocks and indexes like the S&P 500, because those are trading 9:30 to 4 p.m. I always use the analogy. I love fishing. I've been fishing for years down here in Florida, and if you're a fisherman or even a boater, there's a big difference between regular sunglasses and polarized glasses. Polarized glasses cut the glare. You can actually see rocks, logs, fish, structure under the water, especially on a sunny day with a lot of glare, that you cannot see with regular sunglasses. And that's what trading futures is giving you, that extra visibility. You're seeing all these support and resistance levels that occurred at 3 in the morning, or at 7, 8, 9 p.m. at night, whatever it is, that didn't take place on GBTC. And that's why, again, we look at the futures, and the futures gave you that nice time to either exit, and you could have been long Bitcoin futures and for the bounce from when we hit yesterday, and there's where we opened today, and that's about probably the time Bitcoin futures hit that resistance level. So you could have shorted GBTC and sold your long, and that was good for an 11% drop. Again, if there's more upside, I don't think there is, because that's pretty significant resistance we hit. I favor more downside to my third target, about 24.15. Cover a little bit above to be safe. But if we do bounce, big resistance on GBTC at about 39.25. Remember, that gave us our most recent sell signal. That was the bottom of my first target zone, which was hit back here after that sell signal. And then we broke it after testing it several times. We broke it just last week for a quick drop down there. And on a related note, ETCG, the one of the Ethereum ETFs, this one broke the primary trend line yesterday with pretty powerful breakdown, kicked back, not all the way to the trend line yet, but minimum, whether we go back up and hit the $48 would be your next resistance level, 48, then the trend line. Those are all potential bounce targets, but I think it's probably, the bounce is probably over. And so if you're wanting to get out because you were trapped in the breakdown, didn't want to sell yesterday, or you want to take a pot shot to short, again, the short could be based on Bitcoin as well. Now they're moving together. Until recently, Ethereum was rallying when Bitcoin was going down. Remember, put a sell signal on Bitcoin back in February, back here. It was February 22nd, I think it was. So right here, but you can see over the time, Bitcoin was dropping, Ethereum was going up, but now lately they've been moving together. And so my next target, to be very clear, is about $31 right there, and that's pretty high probability target. I think you get a bounce if we get down there. So if you are short or if you're long and you're wondering how much more pain if we do have another leg down, there's no guarantee we'll stop there or no guarantee we'll get there, but that's about a 29% drop from where we're at right now, and I do think we get there soon. Okay, Treasury bonds. A few weeks back, or a couple months back actually, I went long Treasuries, made a case, after this divergent low. I just jumped over to ZB, the futures. Positive divergence on the 60-minute chart. We were in an uptrend. It was working good, but I mentioned a couple trend lines. I can't remember which one. You can see this one broke. This was our more significant trend line. We had minor trend lines along the way, and that one broke. And then the more significant trend line right here broke, and that was it. So that was the last objective stop, get out. And I know I'm making a mess of the chart now, but since then, after that impulsive breakdown, which is a sell signal, we back tested and we remain below it. So near term, more of a dead money trade. I wouldn't short treasuries right now. It wouldn't be long. The comment section, the comment that I had in the comment section below a post the other day was, hey Randy, can you do an update on treasuries? And 401ks, are my only options to go long. I've continued, and for actually the last couple of years now, I've maintained the fact that treasury bonds, let me go to TLT, are one of the worst investments. I used to be a stockbroker, aka financial advisor. In the old rule of thumb, it's older than the hills, long before I got into the business, was the old age minus 100 minus your age for your asset allocation in stocks and bonds. That means if someone was 20 years old, they should have 20% of their money into bonds, because they have a long way to go to retirement, and 70% would be stocks. That's your old rule of thumb asset allocation model. And then as older you get, and you're 70 years old, now you're in or very close to retirement if you're not already in it, and therefore you should have no more than, say, 30% of your money in the stock market and 70% into old steady Eddie bonds, right? And for many years that worked. And the other thing is, bonds usually went up when stocks went down. But as I've talked about, and I don't want to digress too much, I've covered this many times in the past, but it's important. TYX, the 30-year Treasury bond. Remember, the Feds took rates to zero. They didn't take the 30-year bond to zero because they don't control it directly. They can try to manipulate and influence the bond market with massive purchases, issuance, and everything else they can do. But overall, this is something that over time these rates are going to be determined by various market forces. Let's just keep it simple. Inflation, the business cycle, and we have been in a multi-decade secular bear market in interest rates. That means bull market in bonds. Interest rates peaked back here in the early 80s, right after Carter left office, Reagan came in, and it's been a very clear downtrend channel. This was our bear market, going down, 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 down. Then the financial crisis hit, the first one in '08, and you can see this blip below the channel right there. That was the first, at the time, what was considered a nuclear option, and then several other rounds of quantitative easing from the Fed, and then the full-out nuclear option, that dwarfed what they did in 2008, and that's what it did to bonds. And so the point is, okay, they've taken them down to as close to zero as you'll get, on a 30-year bond. And there's nothing at this point. At best case scenario, bonds are dead money, meaning the value of bonds, especially in a bond fund, it's going to be, don't get me wrong, I'm not talking completely flat, but within a range. It might trade in a range, and then you're collecting paltry interest, the interest that these long bonds are spinning off, treasury bonds. And then worst case scenario is I and some others now, I'm increasing, hearing more and more people saying, hey, the cat's out of the bag with inflation, Fed's behind the curve, they're going to do what they always do, they're reactive, never proactive. And by the time they realize it and acknowledge it, it's going to be too late, and inflation's going to go up, and that could take long-term rates up. But whether that happens now or we stay here for a while and the Fed just continues to hammer, do whatever they can, there's really no upside in bond prices. And I'm pointing here, I'm probably confusing you. These are bond interest rates. bond rates and prices go in, they move inversely. There's no variation to that formula. It is a one-to-one direct relationship between interest rates and bond prices. And so again, at best case scenario, you can put your money in bond funds in your 401k and you're going to collect paltry interest. You're going to underperform the rate of inflation. Commodities are a better hedge than inflation because bonds are always going to pay, especially now, the real rate of return, which is the rate that bonds are paying, the risk-free rate of return, Treasury bonds, minus the rate of inflation. That's your real rate of return, and that's negative right now. So you're losing money parked in bonds, and you have the potential to lose a whole lot more in the coming, if let's just say your time horizon's 3 to 5+ years, if interest rates go up, because the value of those existing bonds will drop. And so you might say, well, that's good if rates go up, right, Randy? My bond fund is going to pay a higher rate of interest as it's starting to buy some higher bonds. Wrong. The existing bonds they hold, which are the bulk of all the portfolio, will drop in value more so than any offset in rising rates. In other words, if interest rates go up on, from 2 to 4 or 5% on long-term Treasury bonds, that's a measly 2-3% increase in yield. And by the way, that's over a year. That yield, that's what's paid out. That's quoted the annual yield. But the value of those bonds could easily drop 10% or more. And so that's my long-term outlook. TNX, shorter term, the 10-year bond, same thing. You can see, again, I'm going back decades here. This is a secular, we had a secular bull market in interest rates. Inflation rates got really high, and they've been in a secular bear market. And this was really the natural floor back here. Well, actually, no, the natural floor was here. And then the financial crisis hit in '08. That was the first round of quantitative easing, more artificial manipulation of interest rates, and everything returns back to the mean. And the larger you stretch away from that midpoint, the median point, the mean reversion is going to be even more powerful. So this is what we're looking at. And where might interest rates go? Well, why not come and check this trend line again? We've been checking that trend line for over 30 years. This is 30 years of price history here. And we haven't checked it since then. So, Fed can do what they want. I can't tell you when we're going to get there, but that's the next logical target. And if we do, that means interest rates up, bond prices down. And you can look at bond prices by TLT, go weekly chart. And so this is kind of more zooming in, even though this is a weekly chart. There was a big leg down right here in TLT, the 30-year Treasury bond ETF. There's what could be a bear flag continuation pattern. If that plays out as such, Treasuries could come down here, 122.50. That would be my target. And we have support here about 134.32, 134.42. But a breakdown could take us quite a bit lower in TLT. And here, let's do percentage. Let's play that game. So if we drop there, that's a 10.6, almost 11% drop in the value of TLT, which is, let me see if I can get you the current yield on it. Okay, I'm showing a yield right now, 1.58. So again, what that means is right now, if you bought TLT, if that's the correct yield, I just did a quick Google search, it's at $137. If it went nowhere, in 1 year from now, the price was still trading at 137. You're going to make 1.58% in interest, and it's taxable interest if it's not in an IRA or anything. However, if this bear flag plays out, and you can see the volatility in TLT recently, you have, and just that 122, and we could head actually down to that next target, but let's just say that 122.50 target is hit. That's a 10.5% drop. So you lost 10.5% in principal, which you probably lose in a matter of months if that's hit, maybe even weeks. And it's being offset by about 1.5% interest over the next year. So that's what I'm talking about. The interest is just so paltry right now. Your best case scenario, if the Feds come in and just go even more nuclear and somehow do something that can bring interest rates even lower than they are and bring the long-term bond up. But again, the charts are just, that's it. At the end of the day, I'll quit talking about it here. They're at support. So if you want to make the case to step in long on TLT or bond fund your IRA, you can if that support holds and maybe we bounce up. There's a trend line that might come into play right there. Again, right now, I don't see a reason to be in bonds long or short. And then there's IEF again. There's also the same bear flag on IEF right there. There's an impulsive move down. If that bear flag breaks down, what you want to see is an impulsive drop down below it. That probably take us down to this 105.81 level there, and so that's roughly the measured target of flag. That's about a 7% drop if that is hit. First support is about 109 right there, and then 105.81 in IEF, the 10-year, 7 to 10-year Treasury. All right, last but not least, just an update I told you on commodities. Since there's so many out there, I'd be talking for another hour to try to cover them all, but let me show you this. I remain longer term bullish. This is TJP. Lately I've been using this kind of as a proxy because it has so many different commodities: gold, oil, corn, soybeans, cattle, aluminum, you name it, it's all in there. Industrial metals, precious metals. Primary bear market downtrend line, which was broken here, that's bullish, but we rallied up to resistance. We overshot it by a little bit. This is a weekly chart. There's our new uptrend line. So we're in a bull market, and there's an uptrend line that you can buy pullbacks to right there. And there's, these are, support levels. When I look at the daily chart, as I mentioned the other day, we were right here, and I said, here's the thing. We have a clean price channel in this ETF, commodity tracking ETF, and within that channel, you go to the bottom. This is when you want to be getting long, pullbacks to the bottom of price channel. And if you're an active trader, even a swing or trend trader, but you like to micromanage positions like I'll often do, take profits or at least stop adding. You don't want to add when you get to the top of the channel and you're overbought. And then you have these little trend lines, and those are your sell signals. So when you hit the top of the channel, especially after you break a minor trend line like this, the uptrend line within, you go down. So far, that's where I pointed out the other day. We went on to break down below the channel, giving us a near-term sell signal, little kickback rally, and we're moving lower. So this is commodities coming under pressure. And I think part of that is based on kind of everything ties together. The Fed coming in and starting to finally tap the brakes. And so I think people in the commodities trade, at least the smart money, institutions and individuals, like us, are saying, okay, well, maybe they're trying to take a little hot air out of the commodities bubble right now, or bubble. It's not a bubble. It's far from a bubble. Trend, and so that's that. So where it goes, I don't know, but history shows us usually once you hit the top of the channel in reverse, ultimately you're going to go back down to the bottom of the channel. So at this point in time, if and when we get there anytime soon, that's when I might be more interested in adding back to or taking some new commodities positions. Okay, and I was going to wrap it up there, but since I've been highlighting crude recently, this is CL. The other day, last week or so, right here, I mentioned it was at pretty big resistance, 66.63. Remember, this chart rolled from the one I was covering the last few weeks. These are the July contracts now we're trading, and that was your objective short entry mentioned there. And then we went on, hit a minimum target was a pullback to the trend line. We hit that. We broke the trend line. As mentioned recently, a little kickback rally. And we're back below that $63 support now, and again, that should open the door to my next target there of 60.63 right there on crude futures. And if and when that goes, maybe even all the way down here to 57.64. So here's another commodity, one of the commodities rolling over. Pretty impulsive selling so far, and I think more downside to come. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.